According to the great Albert Einstein, the income tax is the hardest thing in the world to understand. As per a well-known quote, there are two types of people who complain about paying their income tax: men and women. Paying taxes doesn't come naturally, and is not a popular idea in any society. Early Romans are believed to have had a taxation system that included consumption taxes, customs duties, and various direct taxes. Even the ancient Persian and Egyptian rulers taxed their citizens. According to historians, Julius Caesar introduced a 1% general sales tax during his rule. Governments need money for the development and maintenance of infrastructure, and various institutions for the rule of law and the functioning of the democratic process. Taxation is the way they made that money, and what keeps the system moving. A tax is a compulsory financial charge, or another type of levy imposed by a government over its citizens, businesses, and corporations. There are various types of taxes. Most of them fall into a few basic categories: taxes on income, taxes on property, and taxes on goods and services. In theory, tax is also a way to redistribute income among the population, as the tax burden on the upper income groups is usually higher than the lower income groups. In modern day, paying taxes is considered a civic duty. However, taxes have been one of the major political controversies throughout history, even before they became a sizable share of the national income. American colonies rebelled against Great Britain when the Americans refused to pay taxes imposed by a Britain Parliament, in which they had no voice. Inequitable distribution of the tax burden triggered the French Revolution in the year 1789. Even in modern days, it is common to see people's resistance to any drastic increase in taxes, especially when the economy is facing a spiral into chaos. In reality, no one likes paying taxes. Oftentimes, people complain about the amount of taxes they are being paid, and are questioned about the rationale for giving back a substantial part of their hard-earned money to the government. Although not particularly popular, taxes are key to economic stability, development, and achieving the common goals of a functional society. Now, let's discuss why governments are cutting tax. Policymakers and economists have long been interested in how potential changes to the income tax system affect the overall economy. Supporters of tax breaks argued that the reductions in income tax rates affect the behavior of individuals and businesses through both income and substitution effects. Lower tax rates raise the after-tax rewards to work, people's savings, and investments, which leads to an overall increase in production. Higher production reduces unemployment and stimulates economic growth, therefore lower tax rates are better for the economy. You may hear about trickle-down effect. Let's talk about that now. An essential element of the tax cut is the trickle-down effect it is expected to have on an economy. Trickle-down economists argued that cutting income tax for high-income people will benefit not just high earners, but the entire society. When high-income earners see an increase in disposable income, they tend to increase their spending, creating additional demand in the economy. The shift in aggregate demand creates more jobs and higher wages for all workers. Alternatively, increased profits for firms in a low-tax environment will encourage reinvesting their extra profits. This again pushes higher growth, wages, and incomes for all. Tax cuts increase workers' disposable power, and the incentive for people to work, leads to higher productivity and economic growth. These are typically the major intended outcomes of tax breaks. In year 1974, supply-side economist Arthur Laffer developed a model to show the relationship between tax rates and government revenue. Popularly known as the Laffer curve, describes the trade-off between tax cuts and tax revenues. The bell curve graph famously suggested that lowering tax rates might increase tax revenue. As argued by the Laffer curve, the high tax burden takes money out of consumers' pockets. This results in a drop in aggregate demand, in the long term, which offsets the immediate increase in tax revenue. When the tax rates cross the tipping point, the curve boomerangs backward. Beyond that point, additional taxes will reduce government revenue, rather than increase it. At the extreme end of the Laffer curve, when tax rates are 100%, government revenue is zero. On the other hand, if the government takes all personal income and business profit, then no one works or produces goods. This ultimately results in the disappearance of the tax base. For more than 40 years, the Laffer curve has been influential to support tax cuts under various jurisdictions. However, many economists are skeptical about the trickle-down effect. One popular argument is based on the marginal propensity to save. Wealthy people have a higher marginal propensity to save, and frequently they save their excess money in offshore accounts to avoid paying taxes. Therefore, when the wealthy gain extra income, only a fraction of their extra income may filter through to low-income workers. A recent study, based on 5 decades of tax cuts, in 18 wealthy nations, found that tax cuts have consistently benefited the wealthy, but had no meaningful effect on unemployment or economic growth. In addition, some studies suggest that tax breaks for wealthy people can solidify inequality through educational opportunities, wealth accumulation, and the growth of monopoly power. Higher incomes accumulate wealth, which leads to further capital gains and income from assets, leading to even higher levels of income and wealth inequality. The economist Thomas Piketty argues that uncontrolled inequality can grow because the wealthy can keep reinvesting their dividends and profit. On the other hand, as per some studies, higher GDP doesn't address the fundamental inequality of capitalist society. Even if tax cuts did lead to higher economic growth, the higher output does not necessarily increase disposable incomes for all. What do you think about the tax cuts and their impact on economies? Will the lower tax regime induce economic growth, as argued by trickle-down economists? Does the Laffer curve explain the real relationship between tax rates and government revenue? Please share your thoughts in the comments section below. Thank you for watching. Please consider subscribing, liking, and sharing, which means a lot to me. I love to see your thoughts in the comment section.